Topic introduces credit risk modeling as a quantitative approach used by financial institutions to measure, monitor, and manage credit exposures. Credit risk models estimate the likelihood and severity of losses arising from borrower defaults or deterioration in credit quality. These models support lending decisions, pricing, capital allocation, and regulatory compliance by transforming complex credit information into measurable risk indicators. Financial institutions use both statistical and structural models to evaluate borrower risk and portfolio performance. Effective modeling improves consistency in risk assessment and enhances early detection of deteriorating exposures. However, model effectiveness depends heavily on data quality, assumptions, calibration accuracy, and the institution's ability to interpret results appropriately. The topic further explains the role of regulatory frameworks in shaping modern credit risk management practices. International standards developed under the Basel Accords establish minimum capital requirements and encourage institutions to adopt sophisticated risk measurement systems. Basel regulations classify credit risk approaches into standardized and internal ratings-based methodologies. Under the standardized approach, regulatory capital requirements are determined using external credit ratings and supervisory risk weights. In contrast, internal ratings-based approaches allow banks to use internal models for estimating probability of default, loss given default, and exposure at default. These frameworks aim to improve risk sensitivity, strengthen financial resilience, and promote stability within the global banking system. A key topic is the distinction between structural and reduced-form credit risk models. Structural models are based on the relationship between a firm's assets and liabilities, where default occurs when asset values fall below debt obligations. These models rely heavily on market information and corporate balance sheet analysis. Reduced-form models, however, treat default as a probabilistic event influenced by observable market variables and statistical relationships. Both approaches attempt to estimate default probabilities and credit spreads, though they differ in assumptions and methodology. Financial institutions often combine multiple modeling techniques to improve predictive accuracy and capture the complexity of real-world credit environments. Topic also examines various credit risk assessment approaches used to evaluate borrower quality and determine appropriate lending decisions. Traditional credit analysis relies on qualitative and quantitative assessments of borrower financial strength, management quality, industry conditions, and repayment capacity. Analysts review financial statements, cash flow generation, leverage ratios, and collateral values to determine creditworthiness. Rating systems are commonly used to classify borrowers into risk categories reflecting default probability. External credit ratings issued by agencies also provide market-based assessments of borrower risk. These approaches help institutions maintain consistency in credit evaluation while supporting portfolio monitoring and regulatory reporting requirements. The topic also discusses advanced analytical approaches to credit risk assessment, including scoring models, portfolio models, and market-based techniques. Credit scoring models use statistical methods and historical data to predict default probabilities for retail and corporate borrowers. Portfolio models evaluate diversification effects, concentration risk, and correlations among exposures to estimate total portfolio risk. Market-based approaches incorporate information from equity prices, bond spreads, and credit default swap markets to infer changing perceptions of credit quality. Stress testing and scenario analysis further strengthen assessment processes by evaluating how adverse economic conditions affect borrower performance. These methodologies enable institutions to identify vulnerabilities and prepare for potential credit deterioration. Finally, topics emphasize the importance of integrating quantitative models, regulatory standards, and sound judgment into comprehensive credit risk management frameworks. While credit risk models provide valuable insights and improve consistency, they cannot fully eliminate uncertainty or replace expert analysis. Financial institutions must therefore combine model outputs with professional judgment, governance oversight, and continuous monitoring to manage risk effectively. Regulatory frameworks encourage transparency, capital adequacy, and robust validation processes to reduce systemic vulnerabilities. By applying diverse credit assessment techniques and maintaining disciplined risk management practices, institutions can improve decision-making, strengthen portfolio quality, and enhance resilience during periods of financial stress and economic uncertainty.